welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
They're a very good predictor of demand. They obviously see their roadmap and what their customers are looking to do, not just buy GPUs, but to really run that software and what future models will look like. So I think, regardless of whatever the estimates are, I mean, I've seen everything from, flat to strong beats and raises, right? The bottom line is the demand for GPUs remains incredibly strong.
It's easy to assume that this is the delayed reaction to the Bybit hack, but I don't think so. The Bybit hack was awful, but it was handled really well. And what's more, by Monday morning, the hole had been filled. Over the weekend, the industry showed that it is maturing, that it is transparent, and that it can come together in times of crisis.
I think the bigger idea is, let's just set a low bar, something that we're comfortable with, given all the uncertainty in the environment, all the policy rifts, as we call them, our acronym, for rates, inflation, FX, and tariffs. It makes sense to set a low bar. But clearly the business seems to have bottomed, given what we saw in the fourth quarter in a number of metrics the company talked about on the call. Big ticket, spending, et cetera.
We got 1 hour to go until the market close. Taking a look at the major averages and seeing a continuation of the selling in some areas, but not everywhere. Not in the Dow, for example, which is up 197 points, or about 0.5%. The S&P 500, though, down 0.25%, and the Nasdaq also down 1%. So it has really taken the bulk of the selling here. This 4-day sell-off that, for the averages that are down, is the worst since about September. One of the triggers today, consumer confidence that we got.
Yeah, so what's interesting, Joe, is we had inflation worries. We still have inflation worries, at least in some corners. But now you do see these kind of growth worries bubbling up.
Yes.
Consumer confidence was interesting. It hits, it disappoints. It mirrors the Michigan survey. And I thought it was interesting how economists were quick to point out to their clients, they made a beeline to that expectations index because that is the most relevant to spending growth. That did weaken, they point out, to an 8-month low. You're against this backdrop now where for both consumers and companies, you are just wondering a ton of uncertainties and unknowns about what really the impact of these potential tariffs is going to be.
Yeah, and those growth concerns now are pushing down yields.
Yeah, look at
So
4.3.
4.3,
right.
That is the lowest. I'm going back to a 1-year chart here. So it's the lowest certainly that we've seen this year, right? Even going back into December. So that's reflecting some of those growth worries that you're talking about here. Also wanted to point out the sell-off that we're seeing in Bitcoin. That's the one. Yeah. That's the 1 year. But if you look at today, yes, down below 90,000. And some will argue that Bitcoin's not really a correlated asset, but it does seem to be a risk-off asset. Sometimes, right, when people are worried about these things. We had the euphoria, the party started at the election, but some of the air seems to get sucked out of there right now. Yeah, and the other thing that we have to talk about is what's happening with large cap tech, because it is really notable what's going on. Just today, right, you've got 6 of the 7 Magnificent 7 that are trading lower. Tesla in particular, after saying European sales for Tesla down 45%. And so that stock is also trading at its lowest here. Let's take a look at a year chart here. Trading at its lowest since it looks like November.
And of course, Nvidia on deck. Really, I mean, you can say this print really seems to be coming at just a critical time for the market. Obviously, the focus there is going to be, it'll be so interesting. It won't be just, you'll have the top and the bottom and the guide, but then there's going to be so much attention, of course, on the call.
Yes.
What does Jensen Huang have to say just about how he sees his business playing out over the near and early
Most definitely. And as we've talked about, it hit a record high on January 6th and has not been able to regain that. One other thing that I want to point out when we're talking about the Magnificent 7, again, collectively, there is an ETF that tracks them. It's called MAGS. It's this round hill ETF. And what we have seen now is that from the highs where we were late last year, we're now looking at about an 11% sell-off in the Mag 7. You know what that means? A correction in those stocks. Now, is this correction going to be followed by a bounce back? That remains to be seen, but we are going to talk to a lot of people about what we're going to see next.
Just the man to ask.
We do.
We're about an hour away now from the closing bell on Wall Street. Our next guest releasing a new note, changing his stance on equities and cash. For more, we're bringing in now Keith Lerner. He is Co-Chief Investment Officer and Chief Market Strategist at Truist. Keith, it is always great to see you. So let's talk about this new note, Keith, because you tell your clients you downgrade equities to neutral, Keith. So you're officially lukewarm. Explain why, Keith. What are the reasons?
Yeah, well, great to be with you all. Well, as you all know, we've been big bulls over the last year. And when we look at the weight of the evidence in our work, it suggests a more mixed backdrop. And we're making that adjustment to reflect that. And as I talk about the weight of the evidence, there's a couple of things that we're looking at. And you all have discussed a bit of this. One thing is the economy. We still think the economy it will be somewhat resilient, but we're certainly seeing some softness. You can look at the economic surprise index, which is now at the lowest level since September. You mentioned consumer confidence, weak service numbers last week. So again, I think we're going through a little bit of a soft patch, which is kind of the buzzword, I guess, this week. So that's number one. The next thing that we're looking at is forward earning estimates for the S&P 500. A pillar of this bull market, as we've discussed in the past, has been the earnings have been really resilient. Well, what we've noticed over the last month now, forward earning estimates for the S&P 500 have started to flatline. Again, that's not catastrophic, but it is a shift in that trend. And then thirdly, when we look at the technical side of the market, the price trends, what you see is a very split market. Only about 50 to 60% of stocks are actually in uptrends defined by above the 50 or 200-day moving average. You put that all together ahead of some event risk and the Fed being on the sidelines and some fiscal tightening, to us, it's prudent to at least make some shift in a risk exposure.
So Keith, for people, we have strategists like you come on all the time. You talk about being overweight or neutral or underweight stocks. And just for the people who are watching at home, right, who are retail investors, it doesn't mean sell stocks. It's neutral relative to what, right? Does it mean like you should keep sort of conventional 40% bonds, 60% stocks in your portfolio? Like, what does neutral mean actually in terms of positioning?
No, I love your question. It's the right one. And because a lot of times, we have strategists, it's like these really big, bold calls. But the reality is, each client has a different benchmark. Some of them are going to be much more aggressive. Some of them are going to be more balanced, like you said. So basically what we're saying is relative to our benchmark, let's just say it's a 50% stocks, 50% bonds. Over the last year, we've had an overweight or more money relative to that benchmark weight in equities. What we're saying is right now, we're above that benchmark. We want to bring back our equity exposure back down towards benchmark. We're not saying this is time to panic. We're not saying this is the time to have 50% cash. But we are saying is that we expect it to be a little bit of a bumpier path. We expect that there's going to be some disruptions along the way this year. That was actually part of our outlook coming into the year. So maybe shaving some of that off and then having a little bit of cash when we see some of these disruptions. And so far, we're only still about 2 or 3% from an all-time high. So we think this kind of corrective choppy period likely has further to go.
Let me ask you, Keith, when you downgraded equities to neutral, you must have been thinking through, okay, well, how could I be wrong? What are the upside risks to my call? So walk us through that.
Yeah, no, as a strategist, I mean, there's no certainties in what we do. That's why we say weight of the evidence. And so what could go well? Well, I think in some ways we're starting to reset those high expectations right now, right? The buzzword, as I mentioned, is soft patch. No one was talking about a soft patch 2 weeks ago. Obviously, we have the big print that you discussed before with Nvidia. That's going to be a big thing in near term. And also, if the administration starts talking back some of the tariffs, that could be a little bit of a relief rally as well. And then also, I mean, maybe in a week or two, some of the soft patch in the economic data actually starts to reaccelerate, or the earning trends start to move up again. So those are all things we're looking at. But again, we're looking at the way the evidence, and I kind of laid out the picture that at least the things in our work have changed. And again, going back to an important point too is, normally if the economy was going to show a little bit of softness, people would start thinking, hey, the Fed's going to start cutting rates. Maybe they're going to start moving a little bit quicker. But they're basically boxed in our view because of the tariffs. And the only way they'll cut more aggressively than mid-year is if the economy really starts to slow down, which we don't want to see from an equity standpoint.
Keith, it's really interesting that the recent crop of data that you're referring to, the soft patch you're referring to, and the vibe shift that we have seen. I mean, it was last week that we were at new highs, right? So and it feels like things have shifted kind of quickly. And even when we were at new highs, the underlying sentiment did not seem to be great. What has changed? What is going on here? And how do you see that further evolving?
Yeah, in our view, when we were making those new highs, as I mentioned, below the surface, actually, there was only about a half the stocks participating. So even though the headline index made a new all-time high, beneath the surface, you weren't as strong. And you also saw things like small caps actually somewhat weaker. I think right now investors are having a difficult time digesting the frenetic pace from Washington. Again, not from a political standpoint, about like what does this mean? And what you're seeing in some of the confidence numbers is there's just more uncertainty. And since you had a string of 2, 3, 4 economic reports that were somewhat weaker, I think that's changed people's views somewhat. Now, also you have to think about this. It's not like the economy is falling apart, but expectations coming into this year, the average economist was expecting U.S. GDP growth well above 2%. In contrast, coming into last year, the expectation was only for 1% economic growth last year. So that bar for positive surprises was really low. And we winded up last year growing, closer to 2.5%. So this year, I think the main difference is that bar for positive surprises was set higher, and we're seeing some modest deterioration relative to those more elevated expectations. And what we're seeing right now is a reset of that. And by the way, the S&P 500 is basically back to where it was the day after the election.
Yeah, indeed it is. Keith, thank you so much. We'll see what continues to happen from here. Appreciate it.
Yeah, thank you.
We're just getting started here on Market Domination. Coming up, we're just under 24 hours away from Nvidia's latest earnings results. We'll speak to an expert on the other side about what to expect from the chip giant. Plus, at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more Market Domination still to come.
This year is going to be great. The fourth quarter will absolutely be a huge record, and the rest of this year is pretty secure in terms of what their largest customers are going to spend.
DeepSeek is driving a surge in demand for these NVIDIA GPUs, these H20s that are China compliant by Chinese hyperscalers.
The fact of the matter is it's 58 times on a trailing 12 basis, which is how people have always looked at earnings multiples, not on what they expect it will do, but on what it has done. And if you compare its earnings multiple to some of the other AI companies, let alone other Mag 7 and of course other S&P names, it's at an incredible premium.
One thing's for sure, everyone has an opinion about Nvidia. The chip giant set to report fourth quarter earnings Wednesday after the bell. You might have heard. But it did also make some news today, announcing it's extending its partnership with Cisco in a push aimed at making it easier for corporations to deploy AI systems. A lot of businesses remain in the early stages of adopting AI systems because of the complexity the shift adds to their data centers. So Cisco and Nvidia said Tuesday in a joint statement they're rolling out and broadening the list of products that include each other's technology in an attempt to remove those hurdles. Joining us now to talk about all of this, Daniel Newman, Futurum CEO, who has his own opinions about Nvidia also. Good to see you, Dan.
Thanks for having me.
So we got this Cisco Nvidia announcement. It's interesting, it's coming out the day before earnings, and it's sort of like AI is intimidating. Let us make it easier for you. Is that kind of the vibe of the partnership here? What do you think?
Yeah, so I mean, we talked, I think, last time I was on the show actually about enterprise being this next big opportunity. And the enterprise, there's a ton of complexity. And of course, we hear all about AI and hyperscale. And when we eventually get around to talking about the earnings, we're going to talk a lot about what the hyperscalers are doing and all the CapEx. But in the end, there's this whole other market, which is the enterprises and their investment, their implementation of AI. And of course, there's the InfiniBand and the Ethernet argument. And so there's going to be a lot of networks set up for AI that are going to run on Cisco infrastructure. So it just made a lot of sense. Now, the timing, I mean, look, NVIDIA earnings is a national holiday now in its own way. So if I were going to put out news, it's never a bad thing to put it right ahead of an earnings day for NVIDIA.
Let me ask you, so heading into this print, NVIDIA stock has done a whole bunch of nothing so far this year. It's done something, it's down about 5%. Why, if you were to bullet point the reasons why that is, the reasons of concern, what would you say they are?
I think some of it was about people really ran out ahead. They saw what was happening and they started buying up and bidding it up. And it got out in front of its multiple pretty aggressively. Now it's actually trading at what I think is a relatively good value from where it's at and where its potential is, Josh. The thing is the market has digested this. The market has accepted that NVIDIA is the early winner. And by the way, $3 trillion market cap is not an underwhelming number for a company that is really still implementing the infrastructure of a technology that most of the revenue is going to come in the future. And that's, I'm not talking about NVIDIA's revenue. Their revenue's now. I'm talking about this whole infrastructure conversion to consumption that we keep talking about. They're building, and the question is, are these ghost cities in China? I don't think that's the case. But when does all this investment start to print dollars?
When does all this investment slow down is the other question, right? We got that report from an analyst who said they were doing channel checks at Microsoft and found maybe the infrastructure spending was slowing.
Yeah, the TD Cowen report that came out, I think it was a little misleading. And the funny thing is every time one of these reports that come out that kind of call the early demise of AI, it ends up being an accelerant for more GPUs.
Well, listen, they weren't calling for the demise. They just said maybe it's not as absolutely gargantuan as expected.
But some of the refuted, besides Microsoft itself refuting and talking about their 10-year horizon, I think Dylan Patel also came out because he was actually running some of the numbers. And he said that their actual expected investment, if they had gone ahead with every contract, was well above that 85 billion CapEx number. So I think they were pulling back on some. Stargate is, of course, a factor. That's going to sort of change the direction of all this investment. And the sort of tenuous OpenAI-Microsoft relationship. I mean, Microsoft was building out for OpenAI, but OpenAI is going to build its own silicon. OpenAI is going to build potentially its own data centers. It's involved in this Stargate project. I think Satya has been pretty grounded in his communications about how he sees this. He sees, yes, we have to spend for this next 10 years, but he's also kind of come out and said, the revenue's not here. We are getting ahead of ourselves. What do they have, 13 billion revenue on a 85 billion expected CapEx this year?
Yeah.
Dan, let me ask you, when that Nvidia print hits tomorrow, crosses the wire, I'm just curious, what are the data points, the metrics in that report you make a beeline for?
Yeah, I mean, the first thing people are going to be looking at is how that margin integrity is holding up. That margin number has been a big part of what's driven it over $3 trillion. I think another big part of it is going to be any sort of communication about the Blackwell ramp. It's not totally clear how much that shipping has kind of hit capacity, and are there any constraints in their Blackwell ramp? Because I think there's kind of this mixed belief. Some people are like, it's fully shipping, it's fully ramped. Other people are hearing there's some heating issues. What's true? And then, of course, I think everybody here will agree, the guide. Over the last 4 quarters, each quarter, the guide has been a little less aggressive. They've been great. They've been big beats, and they've been raises, but that raise from like quarter to quarter has gotten narrower and narrower, making it even more necessary, Josh, that it's perfect. The guide is perfect. I think the whole market is on stilts. And I think if Nvidia comes up anywhere short, even a mediocre guide, I'm really worried about what's going to happen for growth.
I mean, last time the stock didn't do much. The time before that, it fell about 6%. Both of those times, the S&P didn't do much of anything. So, we'll see. I mean, the other thing we have to look for, it's not going to be in the statement likely, but will be in the conference call, is discussion around DeepSeek, right? And we talked to analyst John Vin of KeyBank yesterday, who's confident that the chips that go into DeepSeek, which I think are the H20s, he expects an uptick in demand for those. But I imagine that's a lower margin product than Blackwell, right?
And there's still a lot of uncertainty around H20. There's still a lot of uncertainty around what Trump is going to do with chip controls. And there's still a lot of question marks around the entire DeepSeek proposition and what happened there. What we did learn for sure from DeepSeek is that the more efficient model will actually lead to more GPU demand. That we are, I think, at less than like 0.1% of the consumption of AI. Now, the infrastructure build, we'll keep talking about that, is happening. But when we learn how to build more efficient models and we learn how to make the infrastructure work more efficiently, I think that scale up is going to happen really quickly. And so DeepSeek, we did learn a lot from, Julie, but I do have a lot of concerns that we still really don't know what happened there, and that the actual infrastructure that we were told versus reality, I'm not certain. And then, of course, all the Trump sort of politics going on between us and China and what's going to happen there. I mean, no wonder that the broader market is super uncomfortable. And this is the most uncomfortable I've seen the market broadly about AI since the sort of first big boom around the ChatGPT launch.
So very on stilts. I like that. We're on stilts. Dan, thank you. Good to see you.
Thanks for having me.
Let's get to some of today's trending tickers, starting with Li Auto. The Chinese car maker stock up double digits today. The company posted pictures of its first all-electric SUV. It's called the Li L8. Li Auto is already one of China's top-selling new car makers, delivering over 500,000 vehicles last year. But this is something in the pipeline that would be different for it. It would be more competitive with the sort of SUVs, EV SUVs on the market already.
Yeah, stock has had kind of a rough run if you pull back the chart. Interesting, Bloomberg analysts who know the name recently said, talked about this company's reset in 24. They were saying should set the stage, in their opinion, for EBIT, earnings before interest and taxes, to return to growth this year on stringent cost controls, they called out, along with better scale and efficiency. So some confident notes from that team.
Yeah.
Our next trending ticker, let's look at this one. That is Sempra. That stock plunging today. That's after the energy infrastructure company reporting weaker than expected earnings for the fourth quarter and reduced its financial guidance for the full year. So this one, stock's falling, not just falling, actually falling the most on record here. Did cut the earnings forecast for this year. Reports noting California regulators decide to approve less money than the company asked to collect from its utility customers through electric and gas bills, and that seems to be one of the big issues here.
Yeah, I mean, this is something, we've had these like go-go days of utility companies, but utilities are still a regulated industry. They have to have rate increases approved by their regulator, and it didn't get the full rate increase that it wanted here. So this is the California Public Utilities Commission. It said that Sempra's company in Southern California, Southern California Gas, could collect $3.8 billion from its customers in these increased rates through 2027. The company had been hoping for $629 million more than that. So hence the shortfall here, and the company apparently cutting its guidance for 2026.
And with this move, you have a stock that's now basically flat over
Yeah.
the last 12 months.
Exactly. Our next trending ticker is Alcoa, the aluminum producer, warning on Tuesday that President Trump's plan to impose a tariff on aluminum imports could cost about 100,000 U.S. jobs and would itself not be enough to entice Alcoa to boost production in the U.S. Trump earlier this month said he would impose a flat 25% tariff on aluminum imports, quote, without exceptions or exemptions, in a bid to lift U.S. production of the metal used to make automobiles, cans, other products. The Alcoa CEO making these comments in a conference in Florida.
Yeah, we're clearly advocating based on the fact that this is bad for the aluminum industry in the U.S. He said it's bad for American workers. Per the Journal's write-up, the company said it's going to apparently advocate for an exemption on Canadian imports, which I guess would allow something like 2/3 of the metal consumed here to continue to come across the border without a tariff. We'll see if they are convincing.
Well, and one of the points of this is to bring back production to the United States. And the CEO, Bill Opplinger, commenting on this and saying it's very hard to make an investment decision, even on something like a restart, without knowing how long tariffs will last. That uncertainty about the timing. If you knew, I guess, that if tariffs were going to be indefinite,
right,
maybe then you would have a little more
timing, carve-outs, right,
exactly.
all of that up in play.
Yeah.
Coming up, it is the latest edition of our series, Goodbye or Goodbye. We are going to take a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. Today we're taking a look at rate-sensitive names, and I'm here with Toulouse Capital Management founder and Chief Investment Officer Spencer Hakimian. And let's start with the stock that you're bullish on, and that is JP Morgan. The stock, it's had a little bit of a pullback here lately, but it was recently trading at a record, and the stock is up quite a bit, I think more than 30% over the past year. So let's get to why you still like it and you think it still has more upside. So there's been a lot of talk about the new administration coming in and sort of lightening up regulations on the banking industry. How is that going to benefit JP Morgan?
So, as it relates to big banks, especially commercial banks, Basel III and other regulatory updates that are coming along are going to, at least it's strongly considered by the sector, to help improve profitability. It's going to require less capital up front. And generally speaking, that will help to increase returns on equity, net interest margins, and it'll generally just make a more favorable environment for lending for all big banks.
And their profit margins have already, largely recovered post-financial crisis, right?
Currently, right now, return on equities for a big bank like JP Morgan is basically as high as it's been definitely since after GFC, but even before GFC, we're at like 2005, 2006 prices. So levels. So it's great, and it looks like it may even get a little bit better for banks.
And then also on the sort of macro, big picture policy front, we could be seeing tax cuts coming, or at least an extension of the existing tax cuts. Why is that going to be good for JP Morgan?
Well, at the end of the day, a tax cut will one way or another lead to extra deposits that will flow to all banks. Naturally, JP Morgan being the biggest bank in the United States will get a big amount of those deposits. And these types of deposits tend to be some of the cheapest deposits that banks get in terms of their funding cost. And that's great because they can lend it out, they can go buy US Treasuries with it, they can do a host of activities with it. And, generally speaking, deposits up for a bank, profitability up for a bank. So that's just something that we're keeping an eye on as we get towards Easter and those tax cut conversations begin. Yeah,
speaking of taking it in and lending it out, let's talk about net interest margins, right? Because we've got this sort of higher for longer environment. What does that imply for a bank like JP Morgan?
So it's actually ironically been one of the best things that could have happened to banks, especially the big banks, since late 2022, because big banks have a much lower funding cost than the small regional banks do because of a presumed assumption of safety with dealing with a bigger bank. And because that yield curve is expensive, they're lending out that money at, let's say, 200 basis points above the 10-year. They're getting a very nice interest on their money, and at the same time, rates on, let's say, a checking account have hardly moved at all, and the flow to, let's say, accounts that actually pay a yield, although it's been big, it actually hasn't been so big as a proportion of banks' total, deposits, which are their liabilities. So this is just, we think it's a great environment, and I think we're seeing it in higher ROEs, higher net interest income margins. We think we're seeing it all around.
We have been seeing it, certainly for JP Morgan. So what could go wrong? Let's talk about that. If indeed, there have been some slowing growth concerns creeping into the market here. What would that mean for JP Morgan? And I guess how likely do you think that is also?
So at the end of the day, a bank is, it's a leveraged investment on the growth of the economy. They're lending to the economy. So if defaults were to increase, if credit card charge-offs were going to increase, if people were to default on mortgages, people started losing jobs, this is all going to negatively impact JP Morgan. JP Morgan happens to be one of the more conservative banks in terms of their balance sheet. But nonetheless, anytime you get an increase in defaults and banks are a levered business, it's going to hit them disproportionately. We saw it 2008, we saw it Q1 2020, we saw it in 2023, although that technically wasn't an economic issue. So that's always the big risk when you're dealing with a bank if the economy were to go soft. But with JP Morgan, they are one of the most financially conservative large banks. They hold a lot of cash relative to their required capital. And they have such a big exposure to short duration treasuries that they could adjust their book pretty easily if we were to get into a recession. So if we were to get into a recession, they would be one of the better performing banks in that scenario.
And before we move on to the stock you don't like as much, do you guys hold JP Morgan?
No, we have exposure to the financial sector, but no individual security.
Okay, gotcha. All right, let's get to the stock that you don't think is as good a buy here, and that's D.R. Horton, the home builder. Those shares haven't done very well over the past year. So let's get to what's going on in terms of supply and demand, which is a big deal for the home builders. You say there's oversupply in the Sun Belt at this point.
Without a question.
Yeah.
A lot of the oversupply started in the aftermath of COVID, and as people were leaving the northeastern states towards Florida, towards Texas, towards Georgia, builders responded with excess inventory. And as always, inventory tends to, people get a little bit too excited and build too much relative to what actually ends up happening. That population growth decelerated, and now we're in a situation where Florida is oversupplied, Texas is oversupplied. We're seeing parts of the Carolinas start to get somewhat oversupplied. And at the end of the day, this is a builder that has to move inventory. So if it can't move it, it's going to have to lower its price. And that's a lower margin, profit margin than what the Wall Street may be expecting.
Right. Margins have been a big focus, I know, for investors. Whereas policy might be positive for the likes of JP Morgan, maybe not so positive for D.R. Horton on a number of different fronts, whether we're talking about tariffs or immigration. Walk me through that.
Sure. So let's just start with tariffs. Higher steel prices, higher aluminum prices, higher, any type of raw material prices. That's all going to feed into higher home prices. At the same time, when you have that oversupply, it's very hard to justify making your customer base absorb that cost. So if you were to model it out, you would expect that more of that cost would have to be absorbed by the home builders rather than by the consumers. And that would, again, lead to lower profits. And then again, housing is just a function of population growth to a pretty big extent. Less immigration, whether it's good or bad for, politically, that's just going to mean less people than what was, priced in, let's say, in 2023 or 2024. And if that happens, there's just simply going to be a little bit less demand for housing. And that means, again, builders are going to, we might see supply build up, and it could be a hard situation for builders in 25 and 26. And
then there's rates, which cut both ways, right? We had talked about the JP Morgan upside. Obviously here, high mortgage rates have been a real issue for anyone buying a home, whether it's a new home or an existing one.
Definitely. And specifically in the case of D.R. Horton, they're selling new homes. So the new home market does not have the people that are insulated from rates that are stuck in those 2021 2% rates. These are all people that are going to have to assume a new mortgage. So the demand for a new home is a lot lower than the demand for an existing home. At the same time, D.R. Horton, to try and move inventory, does something called a rate buy down, where they subsidize a portion of your mortgage for a couple of years. And again, that's just expensive. These are all things that are raising the costs for home builders, and at the same time, we don't see the demand out there for new homes right now.
And then finally, I guess what could switch the thesis here on D.R. Horton if we see a longer-term decline in rates?
If we can somehow manage to get the long end of the yield curve, so 10s to 30s, to fall sustainably, and for a long amount of time, not just for a month or 2 months or 3 months, but for half a year, year and a half, while not having the economy fall into some kind of recession. Because, the long end usually falls when we're in a recession or a growth scare. If we can somehow manage to get that, we can eventually move these homes. Consumers still have jobs, they still have cash, asset prices are just off all-time highs. So consumers can buy homes if rates get a little bit more affordable and, the economy is still there. So things can always change.
Things can always change. Spencer, thank you so much for coming in. Really appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
All right, let's get to a couple more trending tickers now. Shares of Planet Fitness are falling. The company reporting fourth quarter earnings and missing on earnings growth projections. You can see the stock down almost 10% here. So gym operator offers a forecast for annual adjusted earnings per share growth that does miss. They see adjusted EPS growth of 11 to 12%. Estimate was more like 13%. The execs trying to sound a confident tone here. They talk about strong results in 24, 19.7 million members, revenue growth of more than 10%, growing adjusted EBITDA by about 12%, but that is not good enough for investors today.
Yeah, Planet Fitness has had some management shakeups over the past couple of years here. So just putting that in, throwing that in as well. The stock has gained quite a bit.
Run. Yeah.
It's up more than 40% over the past 12 months. So kind of let's put that into context as well when we look at this disappointing forecast and about the decline here. The company is planning to open new clubs, about 160 to 170 new locations. So we'll see how that feeds into the forecast as well. Let's talk about Keurig Dr. Pepper. Those shares rally, the company beating fourth quarter earnings estimates on the top and on the bottom line. The share's up just about 2%. And by the way, consumer staples, I noticed, are leading some of the gains that we are seeing today. There was some concern around coffee inflation, right? Coffee costs, as we know, the raw material has been going higher. And so there were some concerns about that they seem to reassure investors about at this point. Organic sales growth beating estimates in the quarter.
Yeah, Jeffries pointed out, saying KDP had a lot to prove in the second half of the year, and they delivered. And they did point out that data point, that Q4 organic sales growth did beat. Truist as a whole, though, says the results they call decent. Hopeful that KDP can deliver on its guide, they pointed out, but highlights, to your point, how coffee and FX headwinds still strong.
Yeah, and for the full year, the company says net sales growth will be in the mid-single-digit range, will increase in the mid-single-digit range. That's what we're looking for.
All right, earnings, we know, have taken center stage this week, but with concerns around the monetary and political policies, how should you be positioning your portfolio right now? For more, let's welcome in Bryant Van Cronkite, Allspring Global Investment Senior Portfolio Manager. Brian, it's good to see you. So let's talk about the action we see today in the markets. S&P 500 here, falling for a fourth day. You see investors ducking into the U.S. bond market for cover. What do you make of the action we're seeing, Brian?
Yeah, it's good to see you again. I think the market's a bit worried about a growth scare here, and they're worried about it in the context of the Fed not being there to support them if it does happen, right? The Fed's in a bit of a box. Inflation's ticking higher. Most importantly, inflation expectations are moving higher, which triggers a change in consumer behavior. All that could lead to a growth scare. You pile on uncertainty around tariffs. We've heard management teams talk about the need to raise prices and the ability for that to destroy demand. And what you have are people getting concerned. They're moving into traditional defensives. They're moving into utilities. They're moving into consumer staples, areas that have been ignored for a long time as everyone got excited about the growth around AI and the strong economy. But this too could come to an end soon. So I think the market's being a little bit more careful about where to put capital today.
And it's been interesting, this move, these sort of rapid whipsaws that we've seen in the market as people sort of are trying to reset their expectations. Brian, where are you looking for in the market that is potentially going to be steady through this, or that is going to end up seeing higher returns through this?
Well, whenever you don't have economic tailwinds at your back, you don't have a rapidly growing economy, you don't have the support of a Fed cutting cycle, what we want to turn to are companies that have financial freedom. The freedom to do what they need to do through the cycle to drive and generate their own growth. And so the key to that for us is owning companies that have uniquely built balance sheets that have the ability to be used to drive growth. And so, for example, I want to own a company like Canadian Pacific. They acquired Kansas City Southern, the railroad company, not that long ago. That acquisition still has many years of synergies ahead of them. And we're buying it at a time when the market's focused on things that are more cyclical in nature. They're worried about volume contraction right now with shipping. They're worried about tariffs putting pressure on overall demand. Pricing within rails has been a little bit weak. All those near-term cyclical pressures are putting pressure on the stock. But the balance sheet's in such a great place that they're going to use that capital for buying back their own stock to support their shares. They're going to use it for organic investments to drive synergies out of that acquisition still. And I think we're going to see CP drive unique growth relative to an economy and a market that might be a little more fearful today.
Well, I'm curious specifically about the tariff effect on something like Canadian Pacific, Brian, because if I'm a manufacturer, I can kind of move stuff around, right, to try and redeploy my supply chain. Canadian Pacific doesn't have, rails are rails, right? You can't move them around. So how do they navigate that?
Well, that's true. Let's start with that. Rails are rails, and we're not building a lot more of them, right? So these are really unique assets that have incredibly durable cash flow power tied to them. We do have the tailwinds of onshoring and nearshoring. So nonetheless, materials and goods have to get to the US and they have to use some sort of shipping to get there. Yes, we might see some shifts in where it comes from Canada to Mexico or somewhere else, but ultimately they get on the shores of the US and need to move around. One of the most efficient ways to do that is through the rails. So you're right. We're not going to see CP change their asset base around the tariffs. We might see their customers move around a little bit, but ultimately I see that equating to very little pressure on their top line and almost no pressure on their margins. In fact, I think margins expand from here as they get the synergies from that last acquisition they made.
Here's another one you like, Brian, Arch Capital. Now that one has not done a ton over the past 12 months, Brian. It's up about 3-4% here. Why is this one a buy?
Well, a lot of that contraction that you just referenced is in the last 3 quarters, the past 3 months. And Arch Capital, stepping back for a minute, is one of the best run insurance companies we've ever found. They're very good at pivoting to where they see the best returns for the level of risk they're underwriting. They're not dogmatic about being in one line of insurance. And so we see them go from casualty and reinsurance through the GFC into mortgage insurance, where they're writing mid-teens returns on equity for the last several years. And now they're pivoting again back to reinsurance, where we're seeing phenomenal returns on equity that we expect them to deliver over the next several quarters and years. But in the near term, people have been worried about some of the reserves they had on book, which was actually, I think, the market misunderstanding the economics and the financial impact of some acquisitions they made more recently. So what I like about Arch Capital is that we're currently writing business that's going to have very high returns on equity. We're buying the company at a price to book around 1.5 times, which traditionally is a very good price to buy the stock. And we're doing so at a moment when this company has tremendous freedom on their balance sheet to buy back their stock. Something this company has done judiciously over time and usually in a well-timed process. And so we feel very optimistic about their ability to use their capital right now to see us through this current environment.
Brian, good to see you. Thanks a lot for joining us.
Thank you.
Coming up, Home Depot shares higher after the company narrowly beat sales expectations in its 4th quarter. We'll speak to an analyst on the other side to discuss the best ways to be positioned in that home improvement sector. Stick around, much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Home Depot announcing Q4 earnings today before the bell, narrowly beating sales expectations and posting positive same sales growth for the first time since 2022 after 8 straight quarters of declines. Our next guest believes Home Depot's earnings are a sign demand is finally beginning to inflect for the home improvement category. And joining us now to help us understand how to play home improvement stocks is David Bellinger, Mizuho America's Director and Senior Analyst. David, it is good to see you. So I do want, David, your take on that Home Depot print because an important sales metric did turn positive. The stock is higher today. What did you make of that report, David?
Hey, thanks for having me back on here. So yes, Q4 was a very solid print for Home Depot. You had the first same-store sales growth number that turned positive in the U.S. since 2022. So a few years in the making here. And then you also had traffic inflect positive. So all good signs, even categories like paint, appliances, outdoor, indoor, garden, big ticket categories, all starting to move in the right direction here. The company's guidance for next year is a little weak, to be honest with you, is a same-store sales growth of 1%. Investors are buying this up, though. They think that's a very beatable number. It sets a nice floor here. You could potentially have a beat and raise story for Home Depot as the year progresses. And that their guidance, too, they don't assume any changes in the macro. Still a pretty weak housing market. Housing activity essentially frozen by higher rates here, but you do have this good replacement maintenance like demand that's starting to inflect better. We think that's a good sign for the overall category.
So I guess the question is, David, what is making that inflect better? And where are you getting your confidence from that it is an inflection and not just sort of a one-off kind of quarter?
Good question. There are a couple data points within this quarter that make it a little one-time like. So you had some weather impacts. You had the hurricanes a few months ago. That drove about 65 basis points of that just north of 1% same-store sales figure. So a little bit that's commingled in here, right? You don't have a clear up and to the right, but I think you're seeing this slow progression that Home Depot's on very easy comparisons. Same thing for Lowe's here. But just the amount of maintenance that a home requires is such a huge positive here. And in the U.S., you've got a housing stock, a good amount of it that's older than 40 years. And that's sort of a tipping point. That's sort of a leaky bucket, as these companies refer to it, that there's always something breaking in your house. You got to get a new appliance. Your kids are banging holes in the wall, right? There's always something going on that you've got to fix. So that demand is starting to improve, and that's sort of a sign of all the pull forward that we had and all this stepped up activity is sort of normalizing again. And then that's where you're seeing this shift to get to a positive low single digit comp again. It's more of a normalization than anything, but it is a sequential improvement from what we've seen over the past year plus.
Pushing ahead, David, so Lowe's reports results tomorrow. What are you expecting to hear there?
Yeah, it should be a very similar setup. So probably not as good as what Home Depot just reported. They did see the pro business outperform. That's where they lean in more. It's about half of their business. Lowe's, that's closer to 30%. So probably not that same amount of inflection that we saw here. But Lowe's has already guided for 2025. They've given some preliminary numbers. Their same store sales number in their base case, right in line with Home Depot's, a +1. So we think the guidance is, well couched. Investors are already expecting this. So no surprises from Lowe's tomorrow, and we think we'll have another good quarter, but not as good as what HD printed this morning.
So you've got a buy equivalent rating on Home Depot, you've got a buy equivalent rating on Lowe's, and you've got a buy equivalent rating on Tractor Supply. David, I'm so excited to talk to you about eggs, which is the topic du jour, and apparently it's chick season. I guess, or we're coming into chick season here at Tractor Supply. I did not know this. People buy laying hens at Tractor Supply, I guess, or specifically they buy chicks that grow into laying hens. And I guess people are going to want to have their own egg sources right now. Talk me through this.
Yeah, thanks for bringing this up. It's a great question. And we think under the radar positive for Tractor Supply. So all this eggflation hysteria that's out there, you don't think Tractor Supply is the beneficiary right away. But when you peel it back, we think they're going to have a nice Q1, Q2 here because of this dynamic. They basically do this Chick Days promotion. So you can go in the store, you can buy some baby chicks. They're a couple bucks each, $2, $4, $5. But what it does, it gets you in the store. It gets a lot of new traffic. You do have people who are latching onto this backyard chicken craze and trying to get their own eggs, avoid these retail prices. Talking about $5 for a dozen eggs or more is a lot, right? So if you can get around that, it's a nice positive. But then these customers, they're spending on other items, right? You're buying a potentially $200, $300, $400 chicken coop. You're buying feed. You're buying heating lamps. There's all these other pieces that go along with it. So they saw this dynamic back in Q2 of 20 when you had one of the initial egg price spikes. So we think it's coming again. We were at the store this past weekend in northern New Jersey, went with my daughters, no chickens left, sold out of a few hundred chickens immediately. So we think that's a good sign. And we had a lot of good feedback on our report about eggflation and tractor supply. We think it's coming, but we do still think it's sort of this sneaky positive for the business.
Chick days.
Chick days, there it is. David, thank you so much for your time, those stock picks. Appreciate it.
Thank you.
And while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Tara Blicker going to be here in a moment to get us up to speed on the action from today's session. I'm going to start with the major averages here. We've got the Dow finishing higher, a real divergence happening today with the Dow higher by about 162 points, or about 1/3 of 1%. The S&P 500 down by 0.5%, and the Nasdaq Composite down 1.4%. Now, remember, last week we got the University of Michigan's consumer sentiment read that disappointed the market. Today, it was the Conference Board's turn. We got their read of consumer sentiment for this month, showing the biggest drop going back to 2021. A lot of concern in the expectations portion of that confidence report. So that was the latest sort of catalyst to send things down, along with some nervousness sort of in the tech sector. Obviously, you saw that in the sell-off in the Nasdaq, and in particular in the continuing sell-off that we've been seeing in the Magnificent Seven. Jared's got a closer look at today's action. Hey, Jared.
Thank you, Julie. Just want to take a quick look at volatility. We'll be taking a deeper dive with Josh in about 30 minutes. Here is the VIX. Now, we're not closing above 20, so nothing to write home about. We did reach just above 21 earlier today, but we do want to keep monitoring this. I'll show you a 6-month chart real quick so you can see some of the spikes as they have evolved, or maybe not here. There we go. Well, let's move on to the sector action, and we can see staples. If there's one bright spot in the market recently, it has been staples, although that is a defensive sector. That's up 1.44% today. Real estate has also been holding things up. Healthcare has been outperforming, and then you get into materials and industrials. Those are the other two green sectors today, but communication services took it on the chin. That's down 1.5%. Energy right behind it, tech right behind that, and you can see this playing out in the Nasdaq 100, where aside from Amazon, you don't really have a lot of green in some of the bigger names. In fact, Tesla was down 8% today. So some goings on there that we will track in tech. And let's just skip over to ARC Innovation. This is disruptive tech. This is smaller tech outside of Tesla. For the most part, you can see Coinbase down 6%. That's with Bitcoin breaking below 90,000 for the first time in 3 months. But we want to stick to tech right now. So let's take a look at the semiconductors. Nvidia down 2.8% ahead of its earnings tomorrow. Also seeing some weakness in AMD, LCRX, and Intel. That's down 5%. So broad weakness, I would say, but not in the staples. There are some bastions. There are some areas of strength in the market. Josh?
Thank you, Jared. S&P 500 extending its losing streak to 4 days in a row now. And our next guest says the fundamentals for the market are becoming more and more nerve-wracking. Joining us now is Steve Sosnick, Interactive Brokers Chief Strategist. Steve, great to see you here on set. So we had inflation worries, and those are still worries, yes, at least in some corners. Now we have these kind of growth worries bubbling up. I'm hearing talk of a soft patch. Steve, we had the consumer confidence report today that disappointed. I believe you use the technical term stinker.
Yes,
I think is how you put it.
Exactly.
So what added up? What are we seeing in the market? Make sense of it for us.
We are seeing malaise. About a month ago, I think it was 2 Michigan reports ago, because they come out every 2 weeks. I sort of got concerned because that number was kind of lousy, and the one-year inflation expectations shot up. And those usually follow gasoline prices at the pump, and yet they shot up and they didn't move. Then you had another one, well, and I forget the exact order. You had another Michigan one that stunk. The long-term inflation expectations went up. You also, in the midst of that, had a terrible retail sales number, which disappointed. And then that was followed up by Walmart saying, yeah, this is all going pretty much the way you think it's going. And so throw on today where the consumer, where the Conference Board numbers came out, and there's no way to sugarcoat those. They stunk, pretty much like retail's. These are shockingly bad. The problem I'm having here is, and this is why I think the bond market, we could call it a flight to safety, but I really do think it's economic fears, because this is back to economics 101. GDP equals C, consumption, plus I, investment, plus G, government, plus net exports. You're slashing G very quickly, and it's not just in Washington, and it's been doing so loudly that it's affecting, all these things have multiplier effects, and we'd ridden a lot of fiscal stimulus higher. Now we're reversing it, and it's affecting people's consumption. So if you take out the G, if you really slash the G, and then you affect the C, which is 2/3 of the economy, you have bond yields going down by 8 to 10 basis points, like we've been seeing.
I like this is an economic class. GDP equals consumption plus investment plus government plus net exports, right? Yes. I need my blackboard behind us. As you well know, there was so much enthusiasm, even euphoria in the market post the election, right? And by market participants, looking for big growth, looking for tax cut extensions and more tax cuts, looking for less regulation. Where are all those people?
Well, that's kind of the problem. And, for example, ground zero for that is both Tesla stock and Bitcoin, which were two of the projected huge winners from the new administration. Now, let's put in perspective. The administration's what, like 5 weeks old? I mean, so there's a lot going on here. But if you look at where the priorities are, it's been to cut. You really haven't mentioned a lot of things that people were banking their hopes on. So you had this wave of enthusiasm. We've seen a tremendous amount of risk assumption, people going after risky stocks because the momentum was there. And those are the stocks actually that are getting the rugs pulled out from them, because I think people got impatient and they got ahead of they really got ahead of themselves. Buy the rumor, sell the news. Well, in this case, it was buy the rumor. And right now there hasn't been the news that they're looking for to give the follow through.
Where, Steve, is the Fed in all this? Because we had another strategist on the show today who recently downgraded equities to neutral. And we asked him, he said, in his opinion, the Fed's basically stuck where they are right now.
And therein lies the other part of the problem, Josh.
Yeah.
I mean, rate cut expectations have been creeping higher. They were down to about one cut plus maybe another 50-60% chance of a cut. When I looked earlier today, we're back to having a full cut in July, another cut in October, and then let's say another 40% after that. That's another sign that people think the economy is slowing down. But to the point you just raised, the Fed isn't, until there's some clarity about tariffs and other economic policies, the Fed isn't going to act barring some real problem. So you run the risk here of the economy starting to decelerate and the Fed sitting on the sidelines with their hands tied. That's a bad situation. It's actually literally the flip side of what we had in 2024, where you had fiscal expansion and a good economy and a Fed that was cutting rates.
As part of the conference board, they also ask folks what they're expecting in terms of stock price movement, right? And so they say the percentage expecting stock prices to be higher in 12 months. You see it there. It went up, and then it's legged down a little bit. It's still at a pretty high level, though. And you've noticed the pattern of, which was a very reliable pattern, of dip buying. People coming in every time stocks pulled back to buy. Is that still happening? Is that trend intact?
It's still happening, but I have to believe some of it's not working quite so well. I mean, for example, we sort of, I don't see all the numbers in depth. Let me be very clear about that to anybody who's listening. But I do look, I do put out a piece once a week with our top 25 most active names. And those are still to the buy side. And the most active names, the most actively bought names over the last week were Palantir and Tesla, which were not exactly big winners. So the faith is still there. People aren't really selling. But at some point, buying a dip has always been a good thing. As I've said, there's probably some guy in Mesopotamia who was buying olive oil when the price dipped, in the marketplace there. It does tend to work, but you have to think about why you're buying the dip. Are you buying the dip just because it's down, just because it always works reflexively? That can get you into trouble. Are you buying something because it's legitimately on sale and you could, you had a good deal yesterday and you have a 5% better deal a week later? Well, then that's a good reason to buy the dip. I think people got away from being selective about buying dips to just reflexively buying dips. And that behavior may need to work itself out.
What about Nvidia? Is that on your list?
Well, it is. Nvidia actually, it's interesting. Nvidia, it got surpassed this week. It's always been number one or number two, but Palantir actually zipped past Nvidia. The activity didn't change in Nvidia, just people started really trading a lot more Palantir. And Tesla, it's always been Tesla and Nvidia, and then Palantir sneaked in. But there the trading has been a bit more balanced. It's more of a trading vehicle. We'll see tomorrow, what comes of this, but I think we all have to be watching and waiting, but the market has shown some, in terms of the options market, we are seeing some risk aversion in play here in Nvidia. They were pricing in about an 8.5 to 9% move for tomorrow, which, considering Nvidia, you think of it moving these big moves, but actually 4 of the last 6 moves have been rather modest. And there's actually what we call a little bit of a downside skew, meaning people are paying a little more in implied volatility terms for downside protection than they are for upside protection, which during most of the AI-fueled enthusiasm, they were either basically paying about the same or actually even paying a little more for the upside.
Interesting. All right. Well, we'll see how that plays out and if those people get caught out or not.
Exactly.
Appreciate it, Steve. Good to see you. Well, Apple shareholders backing the company's efforts to push back against a DEI retreat. Investors in the tech giant voting down a proposal to scrap Apple's diversity, equity, and inclusion initiatives. Here with more, Yahoo Finance's Alexis Keenan. And Alexis, of course, you've been following the DEI rollback really across the corporate world. So what do we hear today at the meeting?
Yeah, so shareholders in Apple are not going to force the company to do what this conservative think tank, the National Center for Public Policy Research, wanted, which was for the company to consider abolishing all of its DEI efforts. We still don't have a tally on the percentage of voters who voted down that proposal, but what they were claiming is what a lot of these proposals are putting on the table and saying. What they're arguing is that corporate DEI now poses legal risks, financial risks, also reputational risks in the wake of two different Supreme Court decisions. One was in 2023, and that's when the court outlawed race as a factor in admissions for college applicants. And the other is a 2024 Supreme Court case that made it made it easier for employees to sue employers based on discrimination. So that's kind of the argument that's being put forward by these proponents. In a question from shareholders, CEO Tim Cook said that Apple has never had quotas. He went on to say that the company's strength comes from hiring the best people. He said, however, as legal landscape around these issues evolves, he said, we may need to make changes in order to comply. So in the background of that, some of this legal landscape, you have the executive order that President Trump issued on his first day in office, doing away with DEA at the federal level and also warning private enterprise that they should be cautious and they should end any illegal DEI. So that's going on. In addition to that, you also have some new SEC guidance that came out of the Trump administration this month that makes it really harder for shareholders to get these proposals, any kind of proposal on the table. Of course, the SEC is a bit of a referee, right, in deciding which challenge proposals are going to make it onto the actual ballots.
So this is settled for now, I guess, until the next shareholder meeting.
Yeah, it's settled for now. Apple is going to be able to carry on and not have to make these considerations. The company has been very strong about standing by its DEI initiatives, and we continue at Yahoo Finance to try to track as many as we can, those companies that are standing by versus doing away with their policies.
Scorecard. Thank you so much, Alexis. Appreciate it. Well, let's get to some earnings now. Intuit shares, they're higher by about 3% following that company's latest results here. Intuit coming out with second quarter earnings per share, $3.32. $2.57 was the average analyst estimates. Although it seems like some of its forecasts might be a little bit short of estimates, the company said for the third quarter, adjusted earnings per share will be at most $10.95. Analysts had been looking for $11.51, but that doesn't seem to be slowing down the stock there, Josh. And the company also reiterating its guidance for the full year.
Yeah, and for this stock, he had not been working. It was down about 10% year to date heading into this print. We get this report, by the way, at some interesting times for the IRS, which is interesting. Acting IRS chief retiring, layoffs at the agency. I know the street very focused on the print, obviously, but also macro indicators, competitive landscape, what the company is particularly seeing in small businesses, just comps and sentiment that'll come up as well.
Yeah, so on that conference call, any effect from the changes that are being made to the tax filing system. But in the meantime, its fiscal second quarter saw revenue up by 17% here. Remember, the company TurboTax is the one it's best known for. It also owns Credit Karma, QuickBooks, and MailChimp. So those are the various divisions.
All right, and tune into Yahoo Finance tomorrow. We're going to be talking to the Intuit CFO at 10 a.m. Eastern. Coming up, we'll get you caught up on a few other tickers that are moving following earnings. Stick around, much more market domination overtime. That's still to come.
Kava shares falling as the company's fourth quarter results hit the wire. Yahoo Finance's Brooke DePalma joins us here with the details. So give us the numbers.
Good afternoon. Well, certainly revenue beat driven by loyalty. We saw same-store sales growth. We also saw higher foot traffic for the quarter. Adjusted earnings per share coming in at 5 cents, coming in less than what Wall Street expected of a 7 cents. Revenue coming in at $225.1 million. That's compared to Wall Street's expectations of $224 million. Now, same-store sales growth did beat on a big print here, up 21% for the quarter and up 13% for the year. Now, it's important to note here that the CEO said when I spoke to him on the phone just moments ago that they continue to win with this value proposition compared to their peers. He said we've seen resiliency with our consumer. We've been kind of a port in that storm with our very relevant value proposition that's clearly been resonating with consumers, driving those outsized traffic growth numbers. Now, guest traffic for the quarter was up more than 15%. Also worth noting here that investors largely looking at that outlook. They do expect same-store sales growth for 2025 to come in between the range of 6% to 8%. Wall Street was hoping for an increase of 7.85%. Now, that is higher than the outlook that they said last year, and the CEO told Yahoo Finance that it reflects that underlying strength that they're seeing and also reflects a normalization after the dynamic growth that they've seen in the past 3 years. They did raise prices in January by 1.7%. They have no plans to increase prices again this year. Also worth noting, I did ask CEO Brett Schulman about inflation. They do expect low to mid-single-digit inflation, both on the labor and the cost of goods front. He said specifically from a tariff standpoint, we don't see any outsized impact. We do source the majority of our ingredients domestically, and we also have a very diversified basket that's made up of 25% produce, 25% proteins, 25% groceries like those seasonings and spices. He said they're not really exposed to one single thing, and that also includes not being overly exposed to avocados like their competitor Chipotle is.
All right, stock down about 4% here in the after hours. Thank you, Brooke. Appreciate it. Workday, meanwhile, they're out with their latest results as well. Let's get you those numbers. So Q4 adjusted EPS 192. That's versus expectations of 178. Q4 revenue clocks in at $2.21 billion. That's versus an estimate of $2.18 billion. So beats there on the bottom and the top. Spinning ahead, in terms of forecasts, I see a Q1 subscription revenue, $2.05 billion. Street was closer to $2.06 billion. And to 2026, they're looking for, let's say, adjusted operating margins of 28%. Is what they're calling for. The street was closer to 27.5%. They see 2026 subscription revenue, $8.8 billion. The street was at $8.8 billion. That stock is higher right now in the after hours. Heading into this print, it had not done a whole lot in 2025. Julian, it was actually down about 15% over the past 12 months. I know some analysts had chalked the underperformance, at least in part, up to what they perceive as sort of expectations management at the company, but we're higher here.
Yeah, it's interesting. Workday and a lot of these other enterprise software companies, there's the expectation that they could be the next wave of companies to benefit from the Gen AI boom. And Workday did kind of go back and talk about some of the announcements it made during the quarter, including some AI agents that it has now. It sort of has an AI agent management system it has rolled out to its clients. So that's one of the things that it's talking about. So we'll see if there's more discussion about all of that on the call. I would imagine that there would be here. But, you know, sales growing 15% in the fourth quarter. So it's kind of plugging along there, but not seeing soaring year over year.
Yeah, I know some bulls, like our friend Brent Till over at Jefferies, likes this one. He's telling his clients heading into the print, he likes the valuation. Says if the company lowers the bar to mid-teens growth, commits to higher margins, he bets investors get more constructive. They're constructive, at least right now, after hours. Shares of Lucid, meanwhile, let's check out those. They are higher following its latest results. And Yahoo Finance's Pras Subramanian here with the very latest numbers. Pras.
Yeah, Josh, so better than expected results here, but I think they'll be updating Lucid's Workday situation with a new CEO transition here. Peter Rawlinson stepping down. 12 years of the company, long run there at Lucid. Kind of shepherded the company through its Lucid Air, the news SUV that just came out. So he's going to step down and have an advisory role. Current COO Mark Rinteroff will be the new interim CEO while they conduct the search. Peter Rawlinson said in a statement, quote, "Now that we have successfully launched Lucid Gravity, I've decided it is finally the right time for me to step aside from my role at Lucid. I am incredibly proud of the accomplishments the Lucid team has achieved together through the tenure of the last 12 years. Now the numbers. Top line results here beat 234.5 million versus 212.4 estimated. A smaller loss than expected here of 22 cents per share loss versus 25 cents on an adjusted EPS basis. And this resulting in an adjusted EBITDA loss of 577.3 million, around the 576 that was expected by analysts. So better than expected results here, matching the loss numbers here, but then also the new shakeup with the top executives. So we'll see who eventually Lucid has in charge there. But Peter Rawlinson, the longtime guy who we've had on before on the show, stepping down to advisor role.
Yeah, big change there. Thank you, Pras. Appreciate it. And we got another company that we are watching, shares of Maple Bear, known as Instacart, but Maple Bear's the corporate name. Instacart sinking in after hours following a miss on its fourth quarter revenue here. Just running through the numbers, that fourth quarter revenue number was $883 million. Analysts have been looking for about $891 million. Fourth quarter orders, 77.5 million. That fell short of estimates, and fourth quarter adjusted EBITDA at $252 million. That number was ahead of estimates. So mixed picture here. The company says its first quarter adjusted EBITDA will be $220 million to $230 million. Analysts had been estimating $237 million. So basically seeing this lower forecast here is what's driving those shares down, in particular down by 8.7%. And really coming on the heels of some of its competitors like DoorDash, which came out with a more positive outlook, Josh.
Yeah, in the letter to the shareholder here, company sounded kind of a positive, optimistic tone. 2024 was a terrific year, they say, for the company. They point out the end of the year with Q4 orders and GTV growth at 11% and 10% year over year, respectively. They point out they continue to have the leading share of sales by far, they say, in both small and big baskets amongst digital-first players. This stock, it was also one of these names that had really strong one. It was up about 50% over the past 12 months, but at least initially now, some disappointment clearly in the after hours.
Yes, most definitely.
All right, time now for What to Watch Wednesday. That is February 26th, starting off on the earnings front. Huge day of earnings, including Salesforce and Lowe's. But tomorrow's big ticket item we know is, of course, Nvidia. The AI juggernaut is announcing full year and fourth quarter results that's after the close. Nvidia recovering from a steep sell-off following the emergence of DeepSeek last month, but analysts still expecting a monster quarter from the company with a significant ramp-up in Blackwell chips. Yahoo Finance will have special coverage of all things Nvidia tomorrow, with coverage starting at 4 p.m. Eastern.
Taking a look at the Fed, we'll be getting some commentary from Atlanta Fed President Raphael Bostic in the afternoon. This comes after comments from Dallas Fed President Lori Logan earlier today. Logan saying it would be appropriate for the central bank to purchase more shorter-term securities when Fed purchases resume.
And moving over to housing, monthly new home sales data for January that's come out in the morning. Economists forecasting sales to drop compared to December to 680,000.
Really, we could have just had Nvidia be the whole What to Watch.
So true. I know.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Yet another mixed day for the markets, with the Dow finishing in the green, but the Nasdaq losing ground again. That tech-heavy gauge has now given back nearly 1,000 points in under a week. We're going to dive into the rest of today's market trends. Then, while Microsoft canceled some data center contracts, most companies just keep spending more and more money on them. We're going to take a look at the current state of the data center market. Plus, first crypto dipped back under 100,000. Now it's dropped under 90,000. And we're trying to figure out and make sense of what's causing that sell-off. Well, there's been a lot of talk, of AI spending this earnings season, with data centers being a huge contributor to capital expenditure forecasts. Data center market has more than doubled since 2022 to over $27 billion last year. And by 2027, it's projected to surpass $41 billion. For more, we're bringing in Peter Daverin, chairman and CEO of Turner Construction Company. Peter, it's great to see you on set.
Thank you, Josh. Appreciate it.
Data center, listen, we talk about this space a lot on this show because it's one where investors are obviously very interested and very excited. You have very unique line of sight there as a construction services company. So I'm curious what you're seeing, Pierre. What have you seen over the past 12 months? What are you projecting ahead?
Well, we started getting into the data center building market about 15 years ago, and there was quite a ramp up over the course of the decade, especially with the hyperscalers and now with the co-locators. And now what we're seeing is 30% of our backlog of over $32 billion is in the data center market, in the advanced technology market. And we believe that it's going to go up to about 40% in 26 and 27. So it's quite lucrative for us. The race for AI is still on, and we can't build them fast enough. What we need is land and power.
Well, you can't build them fast enough. So that's true here in the U.S. I'm also curious, as you look overseas, what are the trends you see, for example, in Europe?
It's the same. Europe and Asia, there's this race for land. There's probably easier way to get power in some of the other places outside of the United States. But the race for land and power in Europe and Asia is still extremely strong for the hyperscalers and the co-locators.
There are some folks, Peter, listen, investors have been very excited about the space, and you can understand why, for good reason. You do hear some question, though, are we overbuilding at that point? To those folks, you say what?
Well, we say that, as the technology changes, you got to remember, when data centers were first built, they were for storage. Now they're for computing. And now AI is going to help them compute even more. So more CPUs need to be stored inside these data centers. More power is required, more HVAC is required. And I think that as technology changes and becomes more advanced, there's going to be more space needed for these data centers all around the world.
You're helping build data center for Meta, right? I'm curious, in Louisiana. I'm curious, talk about that a little bit. What's the cost of that, Peter? What's the timeline to completion?
Well, right. It's public knowledge that the project itself is $10 billion, and it's broken up into different companies building it. But it's a very, very large project, and it's very, very exciting because it's going to be very complex. There's going to be a lot of innovation that goes into that project because the owner is very innovative, and they would like to see efficiencies like they've never seen before. So it's a pretty exciting project for us and for others down in Louisiana.
And why Louisiana?
I think that was a strategic place that they've been looking at for a long time. Obviously, power is available for them, and it's just a very, very good place to be. They're not normally in urban environments. They're normally in more rural environments.
I would imagine, Peter, you are competing in a pretty competitive market. When you think about your company, what are the competitive advantages you bring to the table?
Well, I think that there are 8 million construction workers that will show up for work every day, and there's 120,000 of them in our construction sites. And what we have to do is we have to provide an environment for every construction worker to be at their best, be authentic, and be treated with respect and dignity. eliminate hate and bias, and every day, and treat people with respect and dignity by actively caring for them. We feel that this is a differentiator for us, so that their facilities on the project that are as good as the facilities we have in our office.
You mentioned all those folks showing up to work every day, all these construction workers, Peter.
That's correct.
Obviously, Trump back in office, talking tough on immigration. There's been some questions raised about what that could mean for the construction industry. I'm curious how you think about it.
Well, we have to follow the rules. We have to follow the I-9 rules of employment, and we audit them all the time, and we make sure that everyone is legitimately working on our construction sites, and we're responsible and accountable for everybody that walks onto the site to make sure that they're legitimate.
What about, speaking of all things Trump, lots of hot talk about tariffs. I'm just curious, how are you all exposed to that, if at all?
We've experienced this before during 2016 and 2020, and since that period of time, and during the supply chain, we put 350 people in our company that just follow materials. So right now, if you say that any construction site, 45% of the cost of the project are materials, we make sure we vet that and make sure that most of those materials come from the United States. And we do that, and we've been doing that since the first administration. So to reduce the opportunity for a tariff to be there, we're doing that constantly.
Peter, great to see you and have you on set today. Thanks for joining us.
Okay, thank you very much.
U.S. stocks closing mixed as Nvidia and Tesla lead the Nasdaq lower, and Yahoo Finance's very own Jared Blickery joining us now with the trading day takeaways. Jared.
Takeaway number one is we have a little bit of a tech rout on our hands, and we're going to explore some of the statistics here. Now, you'll note the Dow did close in the green today. I believe it closed in the green yesterday. So that's why this is not a general market spillover. We still have some pockets of strength, which we'll get to in a second, Josh. But the S&P, here's some stats for you. S&P 500, lowest close in a month. Same for the Nasdaq 100. Nasdaq Composite, 3,000 stocks. That was the lowest close since November 22nd. That's like 3 months away. ARC, that was the lowest close since November as well. Bitcoin touching the lowest since November. A lot of November lows here. And ARC, Russell 2000, that's what I wanted to get to. You got to go all the way back to September for that one. So it's been kind of rough here, and we're seeing it spill over into crude oil. Crude oil had a nasty day. 10-year yield, that's spilling lower. So there's this flight into bonds that we're looking at. And when people cram into, well, I shouldn't say the word cram, but when people fly into bonds, when they move into bonds, that's not always the most bullish thing. Same for staples. Consumer staples has been up. Healthcare is holding on. Those are arguably those are arguably defensive. But then we have Apple. Apple has been a kind of a strange case, and so that's been holding up as well. But I think the biggest thing I've been looking at here, I've been looking for historical analogs. This is the S&P 500 over the last 6 months. This structure right here, over the last few days, 4 days ago, we had a record high, very reminiscent of a few years ago in 2022. I'm going to have to put a 5-year chart. It's going to be hard to see, but if you were to look at a daily chart right there, it looks very similar to what's happening here. Not saying that it has to happen, but that's what we're up against, and that's what I'm watching for potentially.
And now, though, I got Nvidia earnings on deck. So the CEO, Jensen Huang, can he come in, save the day?
I'll tell you what, it might still be all about Nvidia, but I'm not sure. And what I'm looking at here is volatility. Volatility is thy name. We saw the VIX perk up today. It spiked above 20, and that's kind of a psychological level. You got to be careful about reading the tea leaves of the VIX, because you can read a little bit too much into it. It's kind of easy to do. Here we go. Here's the VIX I was looking for. And let's just throw a 2-month chart in there so you can see some of these other spikes. We had a late January spike. That was kind of the same area. By the way, if you can't see it, here's the high of the day. Here's that January spike. Here's another January spike. And so these spikes tend to end up in the same area. And if we do roll over in the VIX tomorrow, that doesn't mean that the selling in stocks is over. That just means that the momentum, that big momentum that we hit to the downside today, that is lessening. So my eyes are on the VIX. It's at a 19.43, not too concerning, but I do want to watch that. The other thing I'm watching is the bond market VIX, and that is the ICE B of A Move Index. And while that has been heading a little bit higher, that's really nothing to worry about either. I do want to get back to the VIX here because we have a quote or we have a clip here from Kevin Gordon. He's from Schwab. Just talked to him on Stocks in Translation, and he had some things to say about the volatility index and how it's a little bit different this year than last year. Let's take a listen.
In terms of the policy backdrop and all of these cross currents, whether it's on tariff policy, whether it's on immigration, we think that's going to be a much bigger and significant driver of index level volatility this year. And to some extent, you've already seen it at the, just in the short time we've had in 2025. But that's definitely a theme we see persisting this year. Not that it means it's a bad year for the equity market, but it's just going to look different than it was in the last year and a half.
I think this year already looks much different than last year, especially with the Mag 7 really just not pulling their weight. Again, all eyes on Nvidia tomorrow, but who knows if they're going to be able to save the day.
Lastly, speaking of volatility,
crypto. So crypto fell out of bed today. That's a big one. Crypto craters, not just Bitcoin, although that's what we're going to look at first. A lot of the altcoins have been showing weakness lately, but Bitcoin has been trading in a range from about 90,000 to, let's say, 107,000, something in that range, and it finally broke 90,000 today. So that's kind of a big deal. And for all the bulls, all the Bitcoin bulls out there, I know I like to talk about the false breakdowns in Bitcoin. And so that could be another one that we're looking at here today. This could be a false breakdown, but we need to see a swift rise above 90,000, ideally above 92,000 in the next day, in the next 2 days, and then maybe a launch higher. So this is looking a little bit bearish for crypto. Let me just show you the 5-day total for all of the coins here, because Bitcoin is actually one of the best off here. We're looking at declines of 15% all the way to 8%. The list goes on. And then you look at the year to date, some of these things are down half. They've been cut in half. So crypto not looking the strongest right now.
All right, the good news, we're going to keep talking all things crypto coming right up in the next segment.
Well, that is good news.
Thank you, buddy. Stick around. More Ask for a Trend right on the other side. The Trump crypto rally seems to be faltering. Bitcoin seeing its biggest drop in 3 weeks as it briefly dipped below 87,000. But our next guest is looking at bright spots ahead for crypto. Movement Labs co-founder Cooper Scanlon joins us now to discuss. Cooper, it is good to see you. So Trump wins re-election, Cooper. The party starts, right? Dancing bears and rainbows. But now we seem to be fading here. I look at Bitcoin. It's hitting a 3-month low. What explains this, Cooper?
Yeah, it's great to be here, Josh. I'm calling in live from ETH Denver right now, the biggest crypto conference in America. So sentiment is still strong on the ground here, looking at this as a blip on a long-term horizon of technical innovation and excitement for what's to come in the US regulatory market. I think that what we're seeing market-wise is consumer confidence dropping nearly 7% from 105 points to 98 points in a single month, alongside inflation and the top performing stocks dipping. So the very foundation of the market is being rattled. And as a 24/7 online industry, crypto tends to feel uncertainty first and the hardest. So it's a very sobering moment to reflect on the foundations that you're building on and investing in.
So Cooper, you're kind of mentioning some kind of macro jitters and concerns. I'm also interested, what about that recent hack of the crypto exchange Bybit? Do you think that's playing any kind of role in this?
Absolutely. You know, our industry is still facing critical security challenges, both technical and social engineering wise. Turning the focus to Bitcoin, if we really laser in on it, we've seen nearly $1 billion leave Bitcoin ETFs in February alone, with about $1.6 billion worth of liquidations in the past 48 hours as well. So as you mentioned, post-election rally is cooling off right now, as the economic and regulatory realities become more apparent that these regulation changes aren't going to happen overnight. But I think that regardless of it, as I mentioned, we're still seeing very high sentiment and interest as we meet with institutions here in Denver and at the upcoming digital asset summits as well.
I am interested, I mentioned the Trump administration. Clearly Trump, listen, he campaigned as a friend of this the industry. You look at his team, Cooper and J.D. Vance and Howard Lutnick, RFK Jr., they're all fans. I'm just curious, so far the moves he's made, and granted it's early days, right? He's only been in there for 5 weeks or so. But are you impressed with the moves the Trump administration has made? Are you underwhelmed? How do you feel about it?
I think that if we look at how things were even last year, it's a much better regulatory environment today than it was before. There's a lot less fear and uncertainty, particularly for US founders. I think that the key thing that we in the crypto industry are excited for and looking forward to is this pathway for real regulatory paths for US founders to bring their companies onshore. I think that what we're going to see from this is a lot of legitimate businesses being able to align more with America. And for the folks who want to remain offshore, it's going to speak volumes to the retail and the consumers as well.
What about this idea, Cooper, of a national digital asset stockpile? Our new AI czar, David Sachs, he's now thinking that over. He's evaluating that. You think that happens? And if it did, what would that mean for Bitcoin?
Absolutely. I think it's exciting to have a very forward-looking administration and to have people that we can really place confidence in, such as David Sachs, looking out for us in the crypto and AI space. I think that recently, despite all of the institutional money leaving Bitcoin recently, I see this more as dipping the toes in the market. You're not going to dive headfirst into it if you're these massive players. And I hope that what they have seen is something that they're going to want to see more of in their experiences with the market thus far, and that this is just the start to a transformation of the digital assets landscape and pushing America to be the very first.
Finally, Cooper, let's talk targets, right? So analysts at Bernstein, that's a smart group, right? Their Bitcoin target, they told clients here, closer to 200,000 over the next 12 months. In your opinion, Cooper, reasonable?
In my opinion, the targets speak for the institutional interest as well as the broader consumer interest via ETFs in asset classes such as Bitcoin. So I would hope that with the recent introduction to digital assets that we're seeing a lot of major banks and institutions, getting their feet wet into, that going forward, we're going to be seeing a lot more of that.
Cooper, great to have you on the show today. Thanks so much for your time. Appreciate it.
Likewise. Thank you, Josh.
Coming up, we're taking a look at the state of earnings estimates in our chart of the day. More Ask for a Trend. That's right on the other side.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
For our chart of the day now, we're digging deeper into earnings season and looking at the health of estimates. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Well, and this has to do with Keith Lerner of Truist, him downgrading stocks to a neutral rating, meaning that basically people should be sort of asset allocated in line with benchmarks right now, not going crazy for stocks, but not selling stocks either. One of the reasons that he talks about is the chart right here, basically that we have seen earnings estimates now kind of go sideways versus what we had been seeing, where they had been gradually moving up and up. And of course, we talked to Keith earlier in the show, and this is what he told us about these earnings estimates.
The next thing that we're looking at is forward earning estimates for the S&P 500. A pillar of this bull market, as we've discussed in the past, has been the earnings have been really resilient. Well, what we've noticed over the last month now, forward earning estimates for the S&P 500 have started to flatline. Again, that's not catastrophic, but it is a shift in that trend.
So you can kind of see here, right, that we had seen them move up, a little lull here, but effectively gradually moving up until the flat line that we're having now. And a lot of the strategists that we've been talking to about their optimism for this year have pointed to the strength, the continued growth in earnings as something that is going to continue to be a driver for stock. So if that's stalling out, it's something that definitely bears watching. All of this, again, has to do with expectations and what is priced into the market. And on that front, Keith also talked about the idea that this year, at this time, that investors are much more positive and optimistic about economic growth than they were this time last year. And in fact, the economic reports have been disappointing. So we'll have to continue to watch the earnings line to see if that comes down a little bit and how the next earnings season does relative to those expectations, Josh.
Thank you, Julie. Appreciate it. Breaking news, shares of Supermicro Computer are spiking higher. That's after hours, the company filing its delayed 10K, meeting that requirement from the Nasdaq to avoid its shares being delisted. Supermicro saying second quarter net sales came in at $5.68 billion. That is shy of the estimate, which was $5.77 billion. Second quarter earnings per share coming in at 51 cents. Now let's take a look at what's trending after hours. First up, Freeport-McMoRan. Those shares are moving higher after President Trump directed the government to consider possible tariffs on copper. The latest move by the White House to tax a wide array of imports and reshape global trade. On a call with reporters, trade advisor Peter Navarro portrayed the move as an effort to stop China's build-out of its copper sector and to address a broader national security vulnerability. Next up, AMC Theaters, the movie exhibitor, announcing fourth quarter earnings, delivering a beat on revenue. The chain also improved profitability compared to the prior year period, while attendance rose 20.2% year over year to 62.4 million guests, which AMC said was a post-pandemic record for the fourth quarter. Food and beverage revenue per patron hit an all-time Q4 high of $7.15. Shares of Caesars Entertainment, they're falling after hours. The company reporting fourth quarter earnings missing same-store net revenue for Q4. That coming in at $2.8 billion. Analysts were looking for $2.82 billion. Las Vegas same-store net revenue also coming in weaker than expected at $1.08 billion. That was a year-over-year decline, 0.7%. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.